Could the stock market be heading for a crash in 2024? It certainly seems to be a question that's on many people's minds. There's a palpable sense of unease, a shiver of worry that's rippling through conversations, news headlines and market forecasts. Business Insider, for instance, reveals that investor fears of a market crash are at their highest since the pandemic began, according to a Yale University gauge. Around a third of individual investors and nearly half of institutional investors see a Black Monday-style crash as a distinct possibility in the coming 6 months. And it's not just these statistics that are causing a stir. Former President Donald Trump has claimed that the current buoyancy of the stock market is due to his performance in the polls. He suggests that the market's success hinges on his political fortunes and implies that a crash could be on the horizon if he doesn't win. However, it's worth noting that these assertions lack substantial evidence and are largely speculative. Certainly there are reasons to be cautious. The Federal Reserve's decision to keep interest rates high could potentially trigger an economic downturn. The current federal funds rate is at its highest since 2001, and there's a 53% chance that it will remain at that level by December. This could impact the strength of the economy, especially as the labor market shows signs of slowing growth and Americans are depleting their excess savings. In fact, the New York Fed has forecasted a 66% chance of a recession by July 2024, with strategists at JP Morgan predicting a potential 15% stock market decline in even a mild recession scenario. However, predicting a market crash is a complex task, and many factors need to be considered. It's not about a single event or a particular person's influence. It's about a constellation of factors, economic, political and social, that can converge to create a perfect storm. So, is a crash imminent? Only time will tell. The key, as always, is to stay informed, be prepared and never let fear guide your financial decisions. Market volatility in 2024 is being fueled by a handful of key factors. High on this list is the role of the Federal Reserve and its interest rates. The Federal Reserve, the central banking system of the United States, has a significant influence on the financial markets. Currently, interest rates are at their highest since 2001, and there's a growing concern that these rates might stay high for longer than anticipated. This prolonged period of high interest rates could potentially lead to an economic downturn. When interest rates are high, borrowing becomes more expensive, slowing down economic activity. As businesses find it costlier to borrow, investments and expansions may be put on hold, leading to slower economic growth. Another factor contributing to market volatility is the slowing growth of the labor market. A healthy labor market is crucial for a thriving economy, as it means more people are working and spending, driving economic growth. However, signs are pointing to a slowdown in the labor market, which could dampen economic activity and contribute to market instability. On top of this, there's a concern about the depletion of excess American savings. During the pandemic, many Americans were able to accumulate savings. As these savings are depleted, consumer spending, a significant driver of the US economy, could slow down, adding another layer of uncertainty to the market. These factors, combined with predictions of a possible recession and stock market decline, are causing unease among investors. The New York Fed has forecasted a 66% chance of a recession by July 2024. Furthermore, strategists at JP Morgan are predicting a potential 15% stock market decline even in a mild recession scenario. This level of uncertainty and potential downturn is a recipe for market volatility and is something every investor should keep a close eye on. In these uncertain times, it is crucial to know how to protect your investments. Amid the chatter of potential market crashes and volatility, it becomes all the more essential to employ strategies that can weather the storm. Let's dive into a few of them. Firstly, diversification. Think of this as not putting all your eggs in one basket. By spreading your investments across various asset classes, sectors and regions, you can potentially reduce risk and increase the chances of generating steady returns. If one sector struggles, your exposure to other sectors can help cushion the blow. Secondly, consider investing in safe assets. These are typically investments that tend to retain or even increase their value during market downturns. They may include government bonds, gold, and certain defensive stocks such as utilities and consumer staples. While returns on these assets may not be as high as those on riskier assets, they can provide a measure of stability during uncertain times. Next is the importance of long-term investing. It's easy to panic when you see the market dip, but remember, investing is a marathon, not a sprint. Market downturns can be opportunities to buy quality stocks at lower prices, and holding on to these investments over the long term can yield significant returns. Moreover, consider dollar-cost averaging, a strategy where you invest a fixed amount of money at regular intervals regardless of the market's condition. This can help mitigate the impact of market volatility and reduce the risk of making large investments at inopportune times. Lastly, stay informed. Keep abreast of market trends, financial news, and any changes in the economic landscape. This will allow you to make well-informed decisions about your investments and adjust your strategies as needed. Remember, the key to navigating through a market downturn is being prepared and staying informed. While market fluctuations may be unnerving, having a solid investment strategy in place can help you remain calm and confident, even in the face of uncertainty. So, is a market crash on the horizon in 2024? The answer is far from certain. We've delved into the complex world of market volatility, examined the factors that could potentially trigger a stock market crash, and explored some strategies to shield your investments from possible downturns. Let's take a quick stroll down memory lane. We've discussed how market volatility can be influenced by numerous factors, including political events, economic indicators, investor sentiment, and even the statements of influential figures. We've seen how former President Trump's claim about his influence on the stock market, while lacking substantial evidence, reflects the potential impact of political events on market dynamics. Then, we turned our attention to the strategies that can help protect your investments in times of market uncertainty. We talked about the importance of diversification, keeping a long-term perspective, maintaining an emergency fund, and adjusting your risk tolerance in response to changing market conditions. But perhaps the most crucial takeaway from our discussion is the importance of staying informed. By keeping up to date with economic trends, political events, and market indicators, you can make more informed decisions about your investments. You can better anticipate potential market downturns and take steps to mitigate their impact on your financial portfolio. In an ever-changing financial landscape, knowledge truly is power. It's the tool that enables you to navigate the unpredictable waves of the market and steer your investments towards safer shores. Thank you for watching this video. If you found it informative and want to stay updated on the latest in finances and investments, do consider subscribing to our channel. Stay informed, stay prepared.